Let's start with the amount of costs that you put into the second quarter. You're really front-loading the, I think, $7.4 billion overall that the restructuring is going to cost you. How much do you expect to get out of the way in 2019?
So absolutely, we're working to execute on the restructuring just as quickly as we can, and with that execution comes the accounting recognition of the steps we've taken. This quarter, we're recognizing about $3.4 billion of costs associated with the transformation. Those are by and large non-cash charges, DTA impairments, goodwill impairments, and software intangibles that we're also impairing. So we get a good portion of the accounting impact already behind us in the second quarter. In the balance of the year, we're working now to take severance and restructuring charges in the second half as we execute on the restructuring. There'll be some real estate charges and some incremental DTA charges in the year. So we're expecting probably another $2 billion of these related charges over the coming several quarters, or 2 quarters in particular.
How hard is that going to hit revenue? I see that revenue is down, I think, 6% on a year-over-year basis, 5% if you take out the specific items.
That's correct.
What are we looking at the end of 2019, ballpark drop?
Well, look, so if I compare to begin with, we'll be comparing with what was a reasonably difficult second half of 2018, and in particular the fourth quarter. So the comparisons will be one thing. Obviously, our goal as a management team is to stabilize the revenues, grow from here. A number of the areas now in the core bank are in fact either stable and growing, whether that's the private bank, the corporate bank, asset management. And so the focus, of course, is on the core investment bank businesses, where we're seeking, again, to stabilize and grow from here. That's the focus of the new management team. That's something we've been working on intensely over the past several weeks. And we aim to deliver in the market conditions that are ahead of us. What
percentage of the job cuts do you think you can get done in this year? I mean, clearly that's a huge portion of the cost. So
sure.
How many can you get out of the way?
Look, it's a steady, gradual process, and it's affecting pretty much all areas of the firm and all geographies. We're working as quickly as possible, but also trying to execute on this as sensitively as possible, given it's affecting the lives of our colleagues and friends. But we're acting just as quickly as we can. We've notified about 900 staff already associated principally with the equity sales and trading business that are either leaving or have left or leaving in near term the platform. The capital release unit is well underway in terms of execution on the deleveraging steps, organizing itself under a new management team, and also moving to, again, reduce the headcount associated with the businesses that we're either exiting or significantly reducing. So we're well advanced, frankly, for 2.5 weeks in, but it's a process that we now need to focus on and continue steadily for the next several quarters and, frankly, years.
But do you have a headcount idea, what target you want to hit for the end of 2019?
We have some internal targets, absolutely. What we said externally was continue to be below 90,000. That's something we intend to achieve and hopefully go as deep into the high 80s as possible, but we don't want to give a specific target at this stage. For a number of reasons. One thing that, as you may see going on, and we've talked about over time, was internalization. So we are continuing to internalize particularly technology jobs. And in the ongoing businesses, that type of activity will continue. So it's a bit of an ebb and flow, hence the reluctance to be pinned down on a very specific target number for the next couple of quarters.
You mentioned the equity sales and trading business. That was down 32%. The fixed income business was down only 4%. And those numbers, as big as they are, compare not so unfavorably to your peers on the street. Why did you do better than expected there?
I agree. So our FICC franchise actually performed quite well, I think, in the environment and relative to peers. That 4% is reported. It's about down 11% if you exclude the TradeWeb gain, which also a number of our peers had. And within that, frankly, rates performed reasonably, solidly. Our credit franchise was up year on year. And so we were quite encouraged, frankly, with the performance in many of our rates businesses, of our fixed income and currencies businesses. I will say, obviously, equities is down significantly. That reflects both the restructuring that we executed last year and also, as you'd expect, some of the uncertainty that played out during the quarter as the market and, frankly, clients and employees were anticipating some element of restructuring to come.
I noticed your provisions for loan losses climbed. and that's not necessarily a Deutsche Bank specific thing, but a macro call. Are you concerned about global growth?
The provision was up year on year, I have to say, against an extraordinarily low level that we recorded in the first and second quarters of 2018. So we see today's level, frankly, still is quite benign. It's 14 basis points of loans. But to your question, yes, we're watching carefully the credit environment. We're not seeing a deterioration at this point. Certainly in what today is PCB, our private and commercial banking portfolios, look to us to be very stable. On the corporate side, there are sort of idiosyncratic credit events that are taking place, but we don't see at this point any broad-based sort of change in the outlook, but it's something we're watching carefully.
Your forecasts in the restructuring release were for interest rates to be higher, and it does look like the ECB, certainly the Fed, are heading down. How difficult is that going to be for you if the ECB, for example, starts to cut rates more negative?
Yeah. Well, first of all, we provided a set of numbers, as one always does. You have to make some planning assumptions. Those happen to be at the end of May, and we are very aware that the outlook deteriorated during June. Frankly, it does represent a revenue pressure for us and all of the banks if rates from here go down further. We're obviously most exposed to euro rates, somewhat to the dollar. And there, frankly, one of the things that we're waiting to see is actually how the central banks go about easing, if easing in fact takes place. For example, in Europe, we are hoping and perhaps expecting some amount of deposit tiering to take place. If the deposit rate gets moved down to shield a little bit the banking sector from more harm from this negative rate environment. But it's something that, as you say, is a significant risk to us. It's something we're managing wherever we can, whether it's around balance sheet management, optimization steps to offset, or even implementing pricing changes in our business. We obviously need to react to the environment that we see coming.
Have you adapted your models down, considering the worsening outlook?
We have. We've been working in ALCO to look at how we're hedging the balance sheet, the way we're managing interest rate risk. Frankly, we started that process late last year with an initial view that it might be a lower for longer world. You'd always like to have been able to do more, but it's something that we manage dynamically. We've also, going forward, got to manage the businesses in ways that offset some of the drag from negative rates.
You have, I saw, CET1 ratio of 13.2, I think?
13.4.
13.4. So you still have quite a big buffer to get down to the limit, and I know the regulator is more willing to let you move down because of the restructuring that you're doing. How much further down do you think that can go?
So look, we manage our capital extremely carefully in a BAU process of offering resources to the businesses to invest in client activity, and managing our numerator, if you like, the capital available extremely carefully. We've indicated that we intend to remain above 13% in 2019, even as we absorb some of the restructuring charges that we talked about at the outset. Going forward, we've announced that we are prepared to see that drop a little bit further into the high 12s, and we've set a minimum of at least 12.5% on a go-forward basis. I do anticipate that we will fall in 2020 below the 13 level, but driven, frankly, by regulatory inflation items, not by the balance sheet itself or even our capital resources, so much as changes in our environment, whether it's the securitization framework or other rule changes coming at us. We still feel that balance sheet, capitalized in the high 12s, is a prudently managed and even on a comparison basis, a very prudent and conservative balance sheet.
Let me ask about some of the businesses. Prime Brokerage, you're in talks to unload that to BNP. Do you feel pressure to do that more quickly as assets flee the business?
So in general, we want to move quickly on the deleveraging, on the business transitions, both for our people, our clients, and to deliver on our promises to investors. Let me start with cash equities. At the end of this week, we'll be entirely out of the balance sheet that was associated with cash. We'll begin shutting down the systems that have supported that activity, just as an indication of how quickly we've moved now in the month of July on those strategic steps. As it relates to prime finance, as we said on the 7th, we've entered into a preliminary agreement that we're working as quickly as possible to bring to a definitive agreement with BNP Paribas. That's gone extremely well in the due diligence process, in the engagement with clients. And so we're working to move that along as quickly as possible. There have quite naturally been some declines in balances with us as our prime brokerage clients shifted those balances to other providers. That's entirely natural, entirely expected by us, and it's been managed in an extremely orderly way. At this point, the work is to continue that orderly transition and to deliver as much of the client business and obviously the underlying technology to BNP Paribas as quickly as possible.
Do you expect to get that done in this quarter?
We're working to get to a definitive agreement just as quickly as possible, and our expectation is we'd be able to close the transaction still in 2019.
DWS has been a bright spot again, and I know you want to grow that business to a top 10, I think, global competitor. Is that possible without taking on an investor that wants a majority stake?
Sure. Well, I'll say to begin with, DWS absolutely has been a bright spot, both in terms of inflows, increases in assets under management, year-on-year revenue growth. So we're very pleased with the performance there. And I'd say more broadly, by the way, the drivers in the business, across the businesses, whether it's loan growth, whether it's increases in assets under management, our wealth management business grew by 4% year over year in the second quarter, if you exclude a couple of one-timers that we disclose. So we are seeing sort of improvements in those drivers, especially assets under management. If I talk about then consolidation in that industry, sure, and we've been I think very straightforward about this. We think there's lots we can do in the DWS franchise to grow from here in terms of product launches, some of the distribution partnerships that we've announced, other actions in the business. But ultimately, growing to a top 10 global provider will mean some form of consolidation. That's something that in time we would entirely expect to engage in, and that it's something we work with the DWS management to evaluate.
If the price is right, will you let go of majority control?
That's not something we've contemplated at this point. Not a bridge we wish to cross. Given the nature of the business, we think of it as an important part of the future of the bank. Both the client, the product, and frankly, the financial profile we want to show to the market. But we do have some flexibility to engage in M&A, given that it's a listed company, dilute ourselves somewhat, hopefully continue to consolidate as we execute on strategies for growth in DWS.
Let me finally ask about C-suite compensation. You've pulled the dividend. You've done this before, and last time you also gave up your bonuses. Is that something that we're going to see again for management?
I think it's too early to speculate on that, and obviously it's a supervisory board decision. What we are engaged in now, very clearly, is defining a set of very near-term milestones and management deliverables, frankly, to meet our promises to investors over the next several quarters. I think the compensation discussion with the supervisory board will follow that.
Is it difficult, though, to manage this restructuring to get to a Deutsche Bank that you and Christian Saving envision during these difficult compensation times? I mean, can you keep the best and the brightest?
Well, we're
at Deutsche
working
Bank?
obviously to keep and motivate our employees, of course, as we do every year. I will say a significant element of the employee base was thrilled with what we announced 2.5 weeks ago. Whether it's around the impact on their own businesses, obviously less so for those that are exiting, and we want to manage that sensitively. But for the businesses that are staying, they really like the corporate clarity that we've provided, and the sense that the restructurings, while there's another painful restructuring to go through, that they will come to an end. We have a basis now for sustainable growth. The reaction within the employee base was frankly quite positive in that regard. And I will say, in particular, in markets like the U.S., where there had been speculation for a time, we've been very clear now the businesses that we are going to continue to do, that we intend to grow in those businesses in the U.S. Equally in Asia, we see growth opportunities for us as a company. Naturally in Asia, given the bridge we are between Europe and Asia. I think employees like the clarity that we've provided. All of us want to go through the restructuring just as quickly as possible and build the company we want to have for the future.